Welcome to the Jones Zone, a podcast by Darryl and JJ Jones, your resource for building wealth and knowledge in everything real estate. Your host, Darryl Jones, a top Orange County real estate agent, has been supporting homeowners for over 30 years. He is here to share his tips and advice, as well as insights from industry experts to help you take your real estate game to the next level. Now, here's your host, Darryl Jones.
Welcome, everyone, to today's show of the Jones Zone. We're here with Pat Leung, a tax expert on real estate. She's just absolutely wonderful. And we're going to talk a little bit about the tax benefits of selling a home. Selling your home can be a daunting task. It's important to understand the tax implications that come with it. We'll explore the tax rules surrounding home sales, including capital gains taxes and the home sale exclusion. We also offer tips on how to minimize your tax bill when selling your home. So welcome, Pat. Thanks for being here. Appreciate it.
Hi, Darryl. Thanks for having me. Absolutely enjoy having the opportunity to chat with you on taxes, my favorite topic.
I know.
My only topic.
Pat is, oh boy, dare I say a savant? No, you're not a savant because you're pretty sharp in everything.
An average Joe Blow on tax.
Pat, what are the tax implications of selling a home?
Sure. So when a person sells their primary, again, we're talking about primary residence, not a rental property home.
Correct.
Okay? When they sell the primary residence, they're going to look at what the sale price is. They're going to take that number minus the purchase cost, not the loan balance, the purchase price that they bought many, many years ago. They can also include home improvement costs. Now, keep in mind, they can also deduct sales costs. Okay, so expenses you pay to a realtor, to the escrow company, title company, all of that could be factored in deducting the costs of the profits when you calculate the gains.
Yes, that makes sense. So in other words, it has to do with exactly the two things of being what you bought it for, the price you bought it for, and then what you netted.
Exactly.
Yeah, and not including loan. And that's something
Correct.
We talked about before in another show about loans. That's a common mistake where people think that they deduct a loan. It has nothing to do with loans.
It would be a severe disadvantage if, say, somebody has no loans, own the property free and clear, has no loans, and they sell the property and there's no loan. They're going to clear, they sell it for $1 million, put aside sales costs, they're going to clear $1 million. Surely they're not going to be paying tax on that $1 million because their purchase price might have been $500, $700, whatever it might be.
Right. Okay. Well, that makes a lot of sense. How can homeowners minimize their tax bill when selling their house? Are there any tips that you can give to that?
Yeah, absolutely. So throughout the life of the home ownership, homeowners should be cognizant if they are doing improvements to keep receipts. And you can scan those receipts and save it in your home computer and keep a home improvement folder. I have one. Just create a folder in your computer, call it home improvement. Every time you buy something to fix up flooring, window treatment, kitchen appliances, or even remodeling your bathroom or kitchen, keep all of those receipts, scan it. And then upon the sale, you can then add up all of those costs, and that would reduce the profits. One other thing that folks shouldn't forget is one way to spice up the cost of the sale price of your home, obviously, is to make it very appealing, right? Via perhaps staging, which our friend Darryl here is very familiar with.
Yeah.
So if, let's say, the homeowner has to pay for staging costs, they can also deduct that. So basically, any expenses related to the selling part, they could deduct those, and people often forget.
But luckily, I actually include this staging in there, but however, that's a very good point. Though there are a lot of people that do have to pay for their own staging, the sellers.
And a lot of realtors don't. I know I had to pay for my staging.
Yeah, no, I luckily have a warehouse full of, it's just phenomenal, great stage. Okay, we're going off in a different topic here, which we will do a show on that. So Pat, tell me, what is the home sale exclusion and who's eligible for it?
Sure. So that home sale exclusion is under the Internal Revenue Code, Section 121, and it provides a tax-free gain of up to $250,000 per person, or for a couple is $500,000. So to be eligible for it, the individual must have owned and lived in that house for at least 2 years out of the last 5 years from the date of sale. So in other words, let's say I'm selling my house today. I got to look backward and look past the last 5 years and ask myself, did I live in it and did I own it for at least 24 months, so 2 years out of the last 5 years? And I can answer yes. Then I qualify for up to $250,000 of tax-free gain.
Now, when someone's doing this and they're talking to themselves, do you recommend that they're in private when they do this or out in public? I'm just kidding.
Now, okay, so one other little tidbit of knowledge that folks don't realize is that $250,000 is per person. It does not say capped at $500 per couple. So let's say if, I don't have that many siblings, but let's say if I have 3 other siblings and there's 4 of us, and 4 of us buy a fourplex, and we each occupy 1 unit of the fourplex, and years later we decide to sell it, each of us now can enjoy up to $250,000 of tax-free gain. That's $1 million.
Yeah, that's impressive. And it's pretty important to note that that's if it's your primary residence.
Primary residence. So in that fourplex situation, we all move in and we each occupy 1 unit as our home.
That's a close family.
With the walls separating us.
Really thick walls. No, I'm just kidding. How does the timing of a home sale impact the tax implications, or does the timing?
A little bit. So let's say I've got a home that I'm selling and it's got tremendous amount of profit, like more than the $250,000 tax-free gain exemption that I'm entitled to. And let's say, my total profit is $350. Of the $350, I can omit $250,000 from tax. And so at issue is $100. And perhaps it's around December and I can time the closing date. If I push it a little bit further out to January of the following year, then now I get to pocket that gain and have an extra year to pay the taxes. Because now, let's say, you were going to list my house in December and it's almost closing the last few weeks, except we push it out to January. I get the profits in January. Now, 2023 profits, I don't have to file into 2024. So I have a full year of enjoying that money and delaying the taxes.
Oh.
Whereas if I had closed it in in December, then a few months later, now I have to pay taxes on it. I don't have as much time to deploy that money for investment.
Makes a lot of sense. And are there any tax benefits homeowners should be aware of in selling their home?
The tax benefit is the $250,000 tax-free gain, basically.
Okay. So we covered that. Can homeowners deduct any expenses related to selling their home? So, for example, and you may have touched on this already, you get to deduct your brokerage fees, your escrow.
Right. Realtors fees, commissions, escrow costs, title costs. If you do staging, you can deduct staging costs. And of course, improvements that have been done throughout the life of the ownership.
So homeowners can determine their basis. Touch on that a little bit more in terms about determining their basis. So their basis being what they bought their house for. That'd be a proper definition?
Correct. If I bought the home, then obviously my basis is the purchase price of that home, plus any improvements that I've made throughout the years. Now, there are other methods of acquiring that home. I could have been gifted that home. Say, Darryl, you're so generous to give me a home.
I'd love to.
Yes.
If I had one.
Thank you, Darryl, in advance. So let's say you were generous enough to gift a home to me, right? And you bought that home for way back when for $250,000 and you gifted to me. Now it is worth $1 million. Put aside gift tax issue. If I received that house as a gift from anybody, you, for example, my basis is really your basis. Your basis transfers over to me. And let's say you gift it over to me and you decide, well, thank you, Darryl, but I don't want to keep it. I'm going to sell it. It's $1 million. I want to take the profit. So now I sell it at $1 million minus sales cost, sales expense. My basis is what you bought it for at $250. So now I get a tax hit of $750,000 because I have not lived there. I've only owned it. I haven't lived there. Conversely, The third option, saying I inherit the house from my parents or whoever.
I was going to suggest that that's the most common. As much as I really like you, I don't know if I'll be giving you $1 million home, but it's kids, right? That's
Right.
where it would really come into play is people inherit the house.
Inherit. You say gifting is not common. It is actually more common than you know, because with a lot of families, they think, I'm going to die soon. I'm going to just add my kid's name on there, not knowing that in doing that, they have gifted a percentage of the house to the kid.
So that's a no-no.
That's a no-no.
You don't want to do that. There's another way to accomplish your goal.
Right.
But
There's a better way.
That way.
It's inheritance. So in that instance, the individual passes away. In their trust, they would designate a beneficiary. The beneficiary would then inherit that house. Now, in that situation, say the same property that you have for $250, and you indicate in your trust that you want your daughter to inherit it, and is now worth $1 million. Your daughter now will have what's called a step-up basis of $1 million.
But that's because I died.
Correct.
Right?
You have to die first.
So you do
Darryl.
have to die first. Oh,
Yes.
Well, that's quite the price to pay for,
Yes.
for
Yes.
that.
So in that case, then your daughter gets the benefit of full step-up basis at $1 million, as opposed to when you gifted the house to me, your basis becomes mine at $250. The beneficiary who inherits a house gets a full step-up at fair market value, dated around the date of death.
Yeah, I've got calls. In fact, I did one last night where people will need to figure out if they do inherit a house, they need to know the value of
Right.
that house at the time of inheritance.
Correct.
Or excuse me, at the time
Date
of
of death.
the
Yes.
date of death.
Yes.
So we can actually go back in time and do those appraisals. And
People often don't know that. They're not aware of that.
yeah, if anybody ever inherits a house, you need to know the value of that house eventually. You might not need it right away, but eventually you're going to need to know the value of that house at the time of death.
Right.
Yeah, that's a big
When you
deal.
think about it, when they inherit a house, there's a few options they have, right? They could either move into it, they live in it, so then they forget about the basis issue, the inheritance issue, or they turn around like me and say, you gave me the house and I don't want it.
Most people sell it, it seems
yes, like your daughter might sell it. And then at that point, say she also sells at $1 million, then the accountant's going to figure out, okay, what is your basis? So we need to figure out what your tax exposure is. So then they will still need to get an appraisal from somebody like you to determine the fair market value for that property around date of death. The third option is they rent out the house. So when they rent out the house, they get a special tax deduction called depreciation. Depreciation is based on the basis of the house. And again,
and you still need it.
You're still going back to the square one issue of what we're talking about.
Now, I heard that there actually have there been any recent changes to that? So, for example, I've heard recently that they passed some rules to where if one inherits a house that let's say a child, has to literally move into the house.
That's the property tax.
That's the property. Okay,
Yes.
That's regarding property taxes.
tax.
Nothing to do with capital gains. It's
Correct.
property tax. So I'm going to talk about that because I think that's a real interesting and that's a new thing that's just recently happened to where before a child, let's say, would inherit a house. Let's say their parents owned it for 30, 40 years, which is common, not uncommon, let's say. And their taxes are relatively low. They're property taxes.
Mm-hmm.
Well, let's say there's a single kid inherits the house and they do have to move in there to keep the property taxes low, opposed to if they just keep it and say, hey, we're going to rent it out.
Right.
And then they go and rent it out. And lo and behold, instead of the $400 a month that their parents were paying in taxes, now they have a $4,000 a month or whatever.
Potentially, yes.
And they have to definitely be aware of that. That's a big deal.
It is.
It's really kind of encouraging. I'm guessing the government did it that way because they want to try to promote selling houses to help possibly relieve a little bit of this housing, lack of housing, I suppose, that we have.
Right. And also because California is the only state that has a limit on the annual adjustment on the property tax. In California, it's limited 3% in adjustment every year. Other states don't have that. Many other states adjust the property tax based on the fair market value. So if you consider the recent run up in prices, somebody who buys in and it goes up 20, 30%, next year, their property tax is going to adjust 20, 30%.
In other states.
In other states.
Yeah.
Yeah. So this particular law, I think it's for the county to recoup, instead of the parents' low basis, now that the new generation has stepped in, they want to charge a tax based on today's value.
Oh, that makes perfect sense. Can you explain the capital gains tax and how it applies to home sales?
Sure. So if I have owned and lived in the home, my primary residence, for at least 2 years out of the last 5 years, I get up to $250,000 tax-free gain. But what if I've owned that home for, let's say, 20, 30 years? I've got some clients for real that have bought Laguna Beach homes for like $50,000.
Yeah, now it's worth $3 million.
I know.
$5 million.
Right, exactly. So that Section 121 home gain exclusion of up to $250,000, assuming both couples are still alive, that gives them only about $500,000. And I say only. But if you factor in somebody who's bought, let's say, a home for very, very low price, is now very, very high in resale value, they have a huge gain in excess of the $250,000 per head count. So at that point, that excess amount is taxed at the capital gains tax rate.
Which, as much as none of us like paying taxes, capital gains tax is relatively kind of a lower tax. Would that be fair to say?
It depends on the individual. So the capital gains tax is, you got to keep in mind one thing, whatever your individual regular other income, like W-2 income, interest, dividend, then you have to slap on the capital gain. And then that would put you at a different bracket.
So it's a different answer for different people.
Different answer, yes. So the rates for capital gain will vary. It starts at 0 for very low income people, but that's not realistic because once I factor in this couple who's got much, much more capital gain in excess of 500, then we're looking at either 15% or 20% or 23.8%.
Is that in federal and state?
Federal. That's only federal.
Okay.
State, say for California, we have no capital gains tax concept. Everything is your regular income tax. So for this couple who say was selling this Laguna Beach home at a huge profit, they're going to be easily at least 10%. California tax actually maxes out at 13.3. So let's just take average 10% California, and let's say they're going to reach 20% for federal. That's in itself 30% hit.
Ouch.
Yeah. So when you say not that much, it's relative, depending on who you talk to.
Yeah. No, that makes sense. Now, also, though, this is interesting. I think something you may have brought up to me at one time, or someone has, where if you do a gain, and this maybe not enough time in this podcast, this could be another podcast too, but when you do a gain, you can also write it off. Let's say you have a stock and you owned a stock and you bought $500,000 worth of stock. It's now worth $300,000. One could theoretically sell that, take a $200,000 loss and write it against that gain. Is that something that would apply here for?
Possible, but that would be a huge sting.
Well, I think the thinking from then it wasn't you that had mentioned that to me, but what I think the thinking was with the stock market being kind of flat right now, I suppose, is that you take the loss of $200,000 and then you go and just buy the stock 32 days later. You buy your whole portfolio.
That's a separate podcast. That's,
is it?
Yeah.
All
but,
right.
To your point, there are other ways. So let's say, in fact, I do have a client that's in this exact situation where they had a capital loss from years ago. And for capital loss, you can only use $3,000 unless there's other gain. So then come this year, they sell that house with a huge capital gain and they've got a large amount of loss rolling from past years. Now they can release those losses to offset the profit that they have this year. Okay. So there are other avenues to consider. And we're talking about is sort of something in the silo, but every individual situation is unique. And there might be other areas that we may not touch on because of each person's unique situation.
That makes sense. Now, are there any tax implications for homeowner sales their home at a loss?
Unfortunately, no.
Unfortunately, no?
Uh-huh.
Tax.
If it's your primary residence and you sell it at a loss, you cannot write off that loss. It's a personal loss. It's not deductible.
Got it. But you can if it's an investment property.
Correct. Yes.
Interesting.
Yeah.
Now, what is a 1030? I know what a 1031 exchange. I have to ask this question as if I don't know, but I know what a 1030. What is a 1031 exchange, and how can it be used in a home sale?
Sure. So a 1031 is a number in the tax code, Internal Revenue Tax Code number 1031. It is an exchange for you're selling a property, investment property, and in exchange
So it's got to be a rental.
It's got to be a rental. You're selling a rental property, investment property, in exchange for another rental property. And your gains, your taxes will be deferred. It's not free. It doesn't get wiped out. You're just kicking the can down the road. So this doesn't apply to a primary residence. To get that benefit, you would have to turn that primary into a rental.
For how long?
1 year, 2 years, 3 years, 4 years, up to you. So I have a house. I lived in it for many years and I turned it into a rental for 1 year or 2 years. I can still now qualify for the home gain exclusion under Section 121, up to $250,000 per person. Now, what if my gain is way more than that $250,000? Like, pretend I own that Laguna Beach home, lived in it for 30 years. Now I moved out. I rented out for 2 years. The home gain exclusion of $250,000 is barely going to make a dent in reducing my overall taxable gain.
Right.
I can then, because now I have rented out the property for 2 years, I can now also do a 1031 in addition to getting the benefit of that $200 tax-free gain. So I can take the gain and split it into two ways.
Wow.
Take this further along. I've now, same home, I've rented out for now 3 years, 4 years, 5 years. Now I don't qualify for the home gain exclusion anymore because in looking back in the last 5 years, I have not lived there, right? I've rented it out for 5 years. That last 5 years window from the date of sale is purely rental. So in that situation, I could do a 1031. Would have to buy another investment property.
Yeah, and then you just kick in the can down the road,
right.
But at least you don't have to come up with that money now.
Correct.
Yeah, it's funny because you and I were talking a little bit about this previously. I had, and I think this is possibly a big misunderstanding with the people out there, is that I was always under the impression that when you did a 1031 exchange, you can start your depreciation over, but you're saying you can't do that.
No. So let's say I've got a rental property that I've owned for many years and I'm selling it with a huge profit, but I don't want to pay the tax. So I do what's called a 1031 like-kind exchange. I buy another rental property and I've had many years of depreciation on my old property.
So let's say 10. You had 10 years.
Okay. When I buy the new one, I don't reset everything. I have to figure out what my carryover base is from my old property, meaning what I bought it for minus depreciation taken in the last 10 years. I get that net basis. Then I have to figure out how much of a step up did I go to when I bought the new replacement property. That becomes the basis for depreciation on the new property. It doesn't get reset from scratch.
Got it. And speaking of that, I've always heard of the 27 and a half years of depreciation.
Correct.
Tell us a little bit about that.
If it's a residential property, so even if I bought, let's say, an 1850 Victorian home, I bought it now this year, my asset life per the IRS is 27.5 years from the date you place the property in service. So let's say I bought a Victorian home built in 1850. I spent the last 5 years fixing it up and I put it in service, meaning I put it available for rental this year. My 27.5 year starts this year.
And it's 27 and a half period, but can
for
you...
residential, for commercial, it's 39.
Okay, got it. For residential 30 or 27 and a half. Can you speed up? We did something. What is that?
It's called cost segregation.
Yeah, cost segregation.
So in a depreciation, you would have to first separate out the land versus the building. Land is not depreciable because it's dirt. Depreciation is really the IRS way of offering a deduction for the homeowner, for the landlord, in terms of writing off the wear and tear imposed on the property by the tenant. And they determined the asset life to be 27.5 years on the building.
Mm-hmm.
But there's another way of speeding up the deduction. It's called cost segregation. You would send an engineer team into the property. They would basically segregate out the costs, hence cost segregation.
Right, which is dividing up the land from the
building, and then further dividing the building and segregating and pulling out assets like the flooring, window treatment, appliances, kitchen cabinets, all of that stuff gets pulled out. So, all of that is 5 year. If I have a house and I've got landscaping, I've got a sprinkler system, I've got a fence and trees and stuff on the outside, that's 15 years. And
Wow.
when I do that, if I take any number divided by 27.5 versus 5 or 15, I get a much bigger number. And by doing that, I accelerate my deduction all up front. Not completely all, but a lot of that deduction up front.
And I'm guessing one would possibly want to do that, let's say if they have a fluctuating income on a high income year.
Right. But there's also some caveats. Just because you're able to do that doesn't mean everyone can benefit from that. Your situation is different, Darryl, than say me. I'm not in the profession of real estate. We do taxes, specialize in real estate industry, but by my occupation, I'm not a realtor. I'm not, a home builder. I'm just an accountant, focusing on that industry. So everybody's situation is different. So we have to take that analysis and figure out whether you can benefit from that.
Everyone's different. So I know it's funny. I get asked a lot of questions and people are wanting, and I don't blame them. I'd want one too, kind of a black and white answer. Yes, no. But
I wish that was the case with tax law. And every time they try to simplify it, they make it more complicated.
The tax law is, what is it, 2,000 pages or something like that?
Oh, it's millions. It's millions.
Millions?
Words.
Of words.
Words.
Which basically means nobody knows what's in there.
Oh, well, I would dare say no one person knows everything in there. That's why there are specialists, just like doctors, right? You wouldn't go to a heart surgeon for cancer treatment or vice versa.
Right.
So in the tax world, there are specialists. There are generalists. Like for us, we specialize in real estate taxation for folks who invest in real estate, developers, etc. And I wouldn't know much about perhaps publicly traded companies. That's a separate specialty.
Got it.
Right. So
with that big, long, million-word tax law, the ones that pertain to real estate.
Exactly. That's all I need to know.
And that's all you need to know. And that's what benefits your clients.
And that's all my brain capacity can hold.
How do the tax implications differ for primary residence versus investment property? In fact, I had a quick thing that I meant to ask this. You mentioned about, for example, not moving into the Victorian style house in your story for 5 years. For it to be a rental, gosh, I think I'm getting the answer with my question. You have to rent it out, or an investment property, I should say. Is there a difference between rental and investment property? Are those exactly the same thing?
From a tax perspective, they're very different. So for a primary residence.
Well, no, not a primary residence. I'm just using words, and I thought this, so maybe some of our audience are thinking this, is in order for it to be an investment property, you have to rent it out. So let's say this, you go and you buy a property and you just, for whatever reason, you don't move into it and you sell it in 2 years and you've never rented it out and you've never lived in it. Where would that fall under?
If you sell it at a gain, you would be hit with capital gains. And because you've not lived there, you don't get to enjoy the Section 121 home gain exclusion.
Okay. And that's rare. I don't know why I asked. Forgive me for asking that question.
It's not rare.
Oh, really?
In fact, it's not rare. In my town of Irvine, there are a lot of homes that I see that are completely dark, like all times dark. And it's because there are a lot of overseas investors who come here and they scoop up these homes and they're left empty.
So they're just kind of planting their money here to where.
Correct. And it's not uncommon depending on the city, but in my city, there's a lot of those.
Yeah, that does make sense. This is a wrap for this episode where we discuss capital gains, home inspection deductions, and taxes on gifting or inheriting a house. Thank you, Pat Leung, for Leung Tax Consulting, for joining me. You can find Pat at www.leungtax.com. That's Leung, L-E-U-N like Nancy, G-T like Tom, A-X.com. Be sure to stay tuned and catch part 2 of Tax Talk, the benefits of selling a home, where we pick back up and discuss tax implications of selling a primary residence versus an investment property and how a 1031 exchange might help you the next time you're considering selling a property. Thanks again, folks. Thanks for tuning into the Jones Zone, your resource for building wealth and knowledge in everything real estate. If you found this information and insights shared in today's episode valuable, be sure to head over to iTunes to rate the show. Leave a review, and subscribe so that you don't miss another episode. Remember, when it comes to real estate, knowledge is power. Stay informed and stay ahead of the game with us. I'll be back next week with even more expert advice and industry insights. Don't miss it. Thank you.